Hey everybody, it's been a while, but I want to make another video because there's a lot of things I want to discuss that I think are very important that no one is really talking about for some reason. Everything I say in this video, or anything I've ever said, is not financial advice. It is a joke at best. Please do your own research. None of this is financial advice. This is just my humble opinion that should be taken as a joke. I am just a retail investor. I have no professionalism at all in this. I am not a profession in this. I am just sharing my views and opinions on things and my thoughts, okay? So none of this is financial advice. Please do your own research. Any decisions you make should be based off your own discretion, okay? I am a joke. I am not to be taken seriously. There are a lot of things I want to go over today because these are things that I'm considering, and in my previous video I did talk about this. One goes into more in depth on some of the things I am looking at, but it goes much more in depth, right? So when you talk about economies or investments or companies, it's a very complex thing that you could probably be discussing for days, if not years, and people are still discussing things that have been going on since the Great Depression and throughout our history. So these types of discussions, I do take a long time because there's a lot of things I want to go over. So yeah, please feel free to ask questions. I generally answer all the questions the best that I can. None of it's financial advice, of course, just my humble opinion. And I do read all the comments. So yeah, do that, and I will try to get back to you. I also ask that you share my videos because I do think that some people find some value in this. I do notice that there are. I'm a neo investor, and I've traded this company here and there along with some Chinese stocks. So I am biased, right? And a lot of things I say are wrong, and a lot of things I say are tentative, right? So they're due to change. Like, my opinions and views are constantly changing. But yeah, so I was looking at a few videos and from Neo, and I was looking at a few forums, and I feel like a lot of them are not discussing things that I find much more important. So this one I talk about Chinese companies and like how the global macroeconomic shifts could be beneficial to China. So I do suggest that you watch this, but I think I gave some of the articles that I was referencing along with some of my notes. So yeah, you should watch that if you think it's important. But anyway, I wanted to go over things that I found that are more important at this current moment, which is like interest rates, GDP, and comparing the markets and some other stuff. So this is going to be a long-winded video. That's just how I am because, again, when it comes to economics or companies or businesses or things like that, it's a very complex topic to begin with, and you want to be all-encompassing to make better decisions, right? You don't want to go off like, oh, I'm going to invest in a company because their delivery numbers was this much and somebody told me to buy at this price. I think it's much more important to gather as much data as possible and then decide to do what you think's best based off your own discretion. So there's no certainties, only probabilities. But with the more data we have, the more understandings and frameworks we have, the better we understand our competition or how the game is played, then we can at least position ourselves to best capitalize on things. So yeah, with that being said, I'm going to get into this video. None of this is financial advice. Please do your own research. This is just my humble opinion based on some of the limited and available data I have witnessed. A lot of things I said will be wrong. A lot of things I've said change. When I watch my videos over time, I'm like, yeah, I don't know if I agree with something that I've said before because things are ever changing. And we need to change ourselves in accordance and respond in appropriate ways to the change. So with that being said, I will get into this video. So there's a few things I want to go over, and we'll start off with the federal interest rates and what do I currently think about them. So in a previous video I was following that we were going to have 3 interest rate cuts, but yeah, with the recent news, it doesn't look like we're going to have an interest rate cut, at least this month. But however, look, if you look at the previous data and the Fed dot plot, over the long run, we're gonna reach lower interest rates of around 2%. And you know what? The Fed dot plot is just a reference, right? It's not entirely accurate. So, yeah, these are just projections. But when you look at the actual Fed's interest rates that have been occurred over time, once you have interest rates lowered, it just drops down drastically, right? So like they'll say, oh, it's gonna take 3 or 4 years for interest rates to drop down a couple percentages, but no, it's generally rapid, right? And as you can see here, even if you have a topping, right, where the Fed decides to pause interest rates, hikes, or cuts, it's good actually, because it's the Fed, at least the Fed is not raising interest rates, right? The Fed doesn't feel like it's appropriate to raise interest rates because supposedly they have inflation under control. But yeah, so anytime the Fed raises interest rates, it's generally pretty fast. Anytime the Fed cuts interest rates, it's generally pretty fast and dramatic, right? So interest rates generally come down fast due to like a domino effect type situation and mechanisms, right? So there's many mechanisms and there's a domino effect. So when interest rates are cut, then money moves around in circulation, the financial industry responds, markets respond, and these things happen in real time. And because we're so digitalized, things almost happen very instantaneously as a mechanism type thing. So maybe in the past it took much longer to respond, but as we become more computerized, things respond much faster. I mean, things have always responded relatively fast though, right? But things are happening more instantaneously. There's more volatility now too. So yeah, because of the lag effects in the markets, it makes holding interest rates understandable, because there's no real reason to cut interest rates at this moment. Because when you look at the current indices for the S&P 500 or NASDAQ, when you look at GME or NVIDIA or AMC or a lot of the United States stocks, they're overvalued, right? So if you cut interest rates more, they could potentially rally, which is even worse because then the PE ratios, they become more overvalued. And then now the markets, which are the US markets, which are already in euphoria, are going to go into even more euphoria, which is not good. It just leads towards a harder crash, right? So it's good that the Fed paused interest rates. As for an election coming up, you can be creative as you want with trying to make predictions off that. And I do have my own, but I don't really think this video is for that because it's a really in-depth discussion. So I'm not going to talk about how I think the Fed is coordinating with the presidential election, but I will give my general overviews on things when it comes to interest rates. So yeah, it makes sense to me that they paused, and with the repercussions, it is good to pause, right? Because you don't really know what's going to happen. So, not this one. Here we go. So when you look at real GDP, right? So gross domestic production is kind of misleading. A lot of the data's and indicators and how the government or Fed presents data is very misleading, which I will go into later in this video. But when you look at GDP, we've technically already been in a recession in the United States between Q1 and Q2 because these are two negative GDPs. But I mean, look at the GDP numbers here. It's relatively on a decline since Q3 of 2023. We could have a more better GDP reported, but again, does it really matter? Not really, because GDP can be misleading, right? GDP doesn't necessarily reflect the health of an economy. So we are in a recession in 2022 with two negative quarters of GDP in Q1 and Q2. But, the politicians were claiming that we weren't, but technically we were. So You may need to gauge what the Fed or the government needs to do through your own frameworks or understandings rather than rely on what the Fed or government says. So you should just get as much data as possible and then try to make your own assumptions about what you think the Fed or the government needs to do, and then place your bets accordingly is what I would do personally. Not financial advice, but you see how much they lie and how things are misleading. Yeah. So in response to that, though, let's see. So when you look at the United States GDP, like, does that mean the health of the economy is going up? Does that mean things are getting better? Probably not, right? So let's see. Okay, here we go. So China's GDP may actually be better than reported due to offshoring of manufacturing and supply chains. And this is in order for China to circumvent US and other countries' tariffs, which allows China to diversify its manufacturing bases. So countries like Vietnam or Thailand, Malaysia, Indonesia, India, Africa, Latin America, and more are now picking up some of the Chinese manufacturing and Chinese supply chains. But so China still benefits from these things. China still rakes in the revenues, but China is offshoring its manufacturing and production to these countries for like maybe low to medium value goods, which China can then produce, use for their own supply chains, or they can export to the United States and countries allied with the United States with tariffs in order to still promote trade. So when you look at China's GDP, it may actually be higher than reported. So this is because China's GDP may be actually higher due to lower domestic production due to offshoring. So GDP is misleading in general, and I think China's economy is much stronger than the United States. While China underreports its GDP, the United States actually, in my opinion, overestimates its GDP and overreports and overstates the importance of the United States GDP with potentially misleading indicators. So when you look at economic data presented by the United States, it can be very misleading. They can gloss it over to make it look better than what it's not. But when you look at Chinese GDP, they'll say it's sluggish, it's slow. However, well, these two countries are in different phases of industrialization. China is leading actually in a lot of these, in a lot of key metrics that shows like the strength of economy. So like, 5G patents, China's leading in, scholarly articles, China's leading, academic papers, China's leading in, patents, China's leading in, trade surpluses, China's leading in surplus, while the United States runs account deficits, and more. So, the GDP is great in some cases, but it's not the all end all be all, right? So, China's GDP may look weak relative to the United States, but again, if China is looking to offshore a lot of its manufacturing in order to circumvent United States tariffs and its allies' tariffs and trade protectionist policies, then your made in China goods may be from like India or Vietnam or Malaysia, but these are Chinese owned factories and Chinese owned manufacturing businesses and things like that. So yeah, the gross domestic production may look lower here, but it's like, okay, actually maybe it's much higher than this, because like how much gross domestic production from China has been sent to like India or China or the Africa or Latin America, which is then sold to the United States in order to again circumvent tariffs and things like that. And so if, in my opinion, it's like, I'll be going into this more later, but the United States wants to make itself seem better for investors and for economic stability, but make China look worse, then this is actually a good thing to do. Like, you can misrepresent the data and say, oh, China's GDP is sluggish, but actually I think China's GDP is very underreported. It's actually much stronger. So I'll be going that later, especially when I start talking about like equities and things like that. So, another thing I've noticed that China's official gold reserves are increasing once again. So, China's central bank and government could be setting up for when the United States dollar depreciates further through quantitative easing or the need to pay off its around $34 trillion debt, national debt, and the interest on it, which is around 1 point, well, not 1 point, but around $1 trillion annually. And this is with consideration to 2 to 5%, with three being the average. So I used a 3% average on that, and it's going to be around a little bit over $1 trillion annually that the United States has to pay off. So that means that the United States has less budget to spend in domestic care like health or social security or education, and they need to pay off the holder of the United States debt. And the Chinese could be selling off United States debt because it may not be that reliable. They could be trying to diversify. They may feel like there's numerous reasons why they're going to sell off United States debts, but maybe they don't want it to be seized. Maybe they just don't think it's that great of an investment. And these are all fair things, but there's numerous reasons why, especially if you think that the Fed could be cutting interest rates. So, the United States may have to move towards quantitative easing and easier money because of numerous reasons. But other reasons why is because recently the European Central Bank and the Bank of Canada is cutting interest rates. So the G7 countries are lowering their interest rates, and the United States may have to respond in order to do so. So while the Fed's primary mandate is to manage inflation, supposedly inflation is around 3.3%, right? So I'm sorry. As you can see here, China is selling off their bonds. But at one point, China was diversifying its treasury bonds. So they're buying U.S. agencies from like Fannie Mae, right? As an example, I believe. I don't know for sure. So like they're buying U.S. agencies instead and just diversifying their treasury bonds. But now you can see China is selling off its treasuries because maybe they don't think the United States is that great of an investment for numerous purposes. But this isn't just China. This is probably a global shift you see away from the United States. So, yeah, the Fed's primary mandate is to manage inflation. It's supposedly around an inflation rate of around 3.3%, supposedly. But, the calculations change to make inflation seem better than what it's not. So the Fed may have to cut rates to be more competitive with other countries, increase economic growth, depreciate the value of the dollar to remain competitive for its exports, and keep dollar-denominated assets offshore. Because if the United States wants to remain competitive in exports, if the dollar is too strong, then the value of United States goods are going to be priced too high. So they'll just find cheaper alternatives in international trade. Another thing too could be is that if the United States dollar becomes too high, then a lot of the assets denominated in U.S. dollars could become less attractive and be sold back to the United States. Well, not all cases, but in some unique cases, as we see with China. But that's also with that's also in response to inflation too, and quantitative easing potentially. So, not all. It depends on which country you're from and your unique position. But I guess the best way to sum it up, because this is a little bit complex for me personally, is that the Fed may need to lower interest rates, because even if inflation is 3.3, how they calculate this 3.3 constantly changes in order to justify why they cut interest rates, right? So they might take certain things out in their formula in order to make inflation rates sound better. So like if you were to add, I don't know, like eggs into how you calculate inflation rates, then maybe the inflation rate would be like 4 on their annual inflation rate calculations. But this changes depending on how the Fed calculates inflation rates. So these numbers may be lower intentionally to allow justification for the Fed to cut interest rates. They'll be like, well, our interest rates aren't at 2, or eventually it will be like at 2.5 or something because they gloss the numbers, and then they'll say something like, so we can cut interest rates. So you and I may not feel like it's much better and that the economy is getting worse, but the Fed will be like, well, the economic data indicates that the annual inflation rate is at around 2%, so we can lower interest rates, right? Because these numbers for 2 is arbitrary. It doesn't really matter. It's just whatever they want to pull out of their hat. So this could also be another reason why the Chinese central banks buys gold to hedge against U.S. fiat devaluation, because China may consider lowering interest rates too in order to remain competitive in exports, to also stimulate domestic economic growth. So again, China's GDP looks to have slowed down, but China's offshoring a lot of its manufacturing supply chains under reports China's true GDP growth rate, in my opinion. So while the United States GDP is much more lackluster. So when you actually look at GDP, of the United States, this is actually not that great of a growth rate, especially because the United States overstates its number, while China is on a great trajectory, in my opinion, and underreports, right? Because again, offshoring, right? Offshoring domestic production. But, with how the United States economy is structured, where it's asset driven, where it depends on these asset bubbles, for to prop up the entire economy for your older demographic and your middle income demographic, your middle age demographic, you need to justify why you increase in interest rates, or why you decrease interest rates in order to keep the debt going. But yeah, I think basically what I'm trying to say is that the Fed will make things look better than what it's not. The government will make things seem better than what it's not, to justify what it has to do in order to keep the debt-driven economy going. This is also apparent too when you use like the Big Mac indicator, when you compare how much you can buy at McDonald's per dollar. Like you could buy a whole meal with $5 like 10 years ago, and now it costs $20 or more, right? So it's like, it doesn't matter if we keep interest rates or inflation rates at these numbers. Like the value of the dollar is going to keep depreciating. So when you look at credit card balances, right, and you look at credit card debt, I think it shows like a more truer health of the real economy, I guess, like you and I, or their average person, which that comprises majority of the economy. So despite the government and the Fed saying things are great so they can justify lowering interest rates, credit card debt is also rising tremendously. So the Fed may need to gloss inflation and economic data to promote Fed interest rate cuts. This could reflect the real economy, or you and I, the average person. But lowering interest rates could allow for easier ways to finance their debt, stimulate more consumer spending, prevent a technical recession, and service people debt, like, kicking the can down the road. So in order to sustain this type of spending, you would need to lower interest rates. This way people can finance their debts much easier, and the government can too. So yeah, it's like if you keep interest rates high, then there's more chances for a default, which is not good, because too much of that would lead towards an economic collapse. So this does matter, but gauging the current financial markets, would it be appropriate for the Fed to cut interest rates? Maybe not, right? Because you look at all the speculative bubbles that are in euphoria, that you may want to find a better time when like certain bubbles pop, like the GME thing or the Nvidia thing. They kind of cool down a little bit. The S&P kind of cools down. The NASDAQ cools down. All these things cool down a little bit. because it's really frothy, and then you may want to consider lowering interest rates. But I don't know. These are just things you'd have to think about, right? Unemployment is also rising, which is not a good sign. So that also leads towards the Fed cutting interest rates as well, right? So real revenues could be declining as the world becomes more competitive for the United States in terms of its like exports. So at the so as other countries move away from the dollar and start trading in other currencies, other countries stop buying U.S. debt, assets, and become more competitive with exports from low, medium, and high. So this includes like your technology companies like TikTok or Meta, Google, or Instagram, right? So like TikTok takes away a lot of revenues from like Meta or Google or Instagram. Other countries decolonizing give the other countries that trade with the United States a less exploitable position, because maybe for every dollar of goods and services the United States trades with Africa, Africa would have to give $100 back in goods and services. But now, with Africa diversifying its economy with trade of China, for example, and strengthening its own economy, then when they either don't have to trade with the United States, or they can just trade with China instead, or they can if they do trade with the United States, they can be like, well, you can't really give me $1 for $100 back. You're gonna have to trade me like $1 for $10 back, or I'm gonna trade it with a different country instead. So this in turn lowers down the revenues, in a sense, of the United States. So basically, it's like if all these countries are businesses and they're all trading with each other, the United States cannot exploit in international trade as much, which lowers down the country's revenues. Which allows, this allows them to get more fair deals when trading with the United States, which lowers the United States revenues in international trade. These things all add up. So, like the United States being an asset debt-driven economy, in international trade, other countries are diversifying away from the United States dollar. They're not buying as much U.S. debt. They're not trading as U.S. currency as much. Countries that trade with the United States want more favorable deals, rather than like a 1 for 10. They want a 1 for 2 or 1 for 1. This all negatively impacts the United States, and this is why the United States has to keep going into more debt to sustain its debt-driven economy. So yeah, here we have more of a chart on the United States debt. It's just non-housing debt and housing debt are rising at really drastic numbers. So now I'm going to be talking more about growth in Chinese stocks. So the first thing I want to go over was the CAPE ratios between the United States and Chinese stock exchanges. So when you look at the S&P, NASDAQ, Shanghai, Hang Seng, and Shenzhen, the CAPE ratios basically gives like it considers 10 years of data, I believe, and then it compares like the PE ratios in a sense, or the book ratios. The thing like it's basically like it's kind of like the PE ratio, but PE ratio focuses more on like a 12-month, I believe, or even the day to day, right? I don't know for sure. I'd have to check. I'm sorry. But yeah, this gives like a more longer time frame. I think. Wait, probably not 10-year, but yeah, these give more realistic values, right? So the higher your CAPE ratios are, the more overvalued you are. The lower your CAPE ratios are, generally the lower valued you are, like undervalued. Like you are an undervalued market. Like you have more room to grow. If your CAPE ratios are higher, then you have less room to grow, and you become more, I guess, more risky in a sense, right? So the S&P, NASDAQ, Shanghai, Hang Seng, you can look at this kind of like PE ratios. Like when these three own the means of production in China, and these are reliant on China and things like that, how do you sustain these numbers? So I also looked at a few different PE ratios of NVIDIA 75.41, Tesla's is 46, Meta's 28, Apple's 33, Amazon's 52, Google's 34, Marriott's 23. Some speculative companies and growth companies are Neo's PE is a negative 2.47. SoFi is at 74.72. Rivian is at negative 1.82. And AMD is 158. And then we have some Chinese blue chips, which is Alibaba at 16.6. Tencent is 15.39. Baidu is 15. BYD is 33. PDD, Pinduoduo is 19. And JD is 15. So when you look at these numbers, in a sense, relative to the United States, these companies are tremendously undervalued when compared to the United States blue chips. And all these companies in the United States, they rely on China heavily. So Nvidia relies heavily on China, which is why they circumvent U.S. government, the CHIPS Act. Nvidia will circumvent the United States government intentionally, but maybe the United States government allows it, right? Because they profit off of whatever Nvidia benefits from too. Tesla relies heavily on China for its most profitable plants and profitable electric vehicles and supply chains and batteries and raw materials and manufacturing. Same thing with Meta. I think they rely on 10 or 20% from Chinese ad revenues. Apple's manufacturing is 90% Chinese, I believe, with most of its supply chains from China as well. Amazon, I believe, is 60 or 70% of all the retailers you see on Amazon, 60 or 70%, they all come from China. And Google, I don't know too much about Google. I haven't looked into that too much. But as you can see here, most of your United States companies that we value so much are pretty much Chinese in a sense. Like they're half Chinese or more, right? So you see the absurdity of this? It's like, yeah, really ridiculous when you really think about it. How much you might as well call them Chinese companies, really half Chinese, because that's how much they rely on China. And when you look at all your stuff around you, it's either heavily made in China, it's either Chinese, or heavily reliant on China. So even with your electric vehicles, but you can understand why the United States wants to keep the status quo, right? Where we rely on oil and ice, right? Because if we rely on internal combustion engines, for example, if we transition to electric vehicles, then China owns all the supply chains and manufacturing and production, while the United States, all the supply chains, like all the components for your car that consists of 1,000 different components, they get eradicated. They're no longer needed. A lot of your oil companies are no longer as needed as much. And so you can see why your industrial base in the United States and supply chains need internal combustion engines, because then your thousands of businesses would not do too well if we transition to electric vehicles. So talk more about Chinese stocks. So I think that with lower interest rates, it means that companies can borrow much more at lower costs. This all allows these Chinese companies to bolster their balance sheets potentially and their financial statements. It also allows for expansion due to lower costs of capital and can promote better future earnings and cash flows, which makes these companies look much more attractive to investors, especially Chinese companies, which in my opinion are heavily undervalued, which is very apparent in their numbers. Bond yields also look less attractive if the United States lowers interest rates, especially when compared to the potential future earnings and earnings of growth stocks and risk stocks like Chinese companies that are heavily beaten down. So when you look at the CAPE ratios, or if you look at PE ratios or other metrics that you use, it's up to you. It looks substantially more attractive to invest in Chinese than the United States companies. So if if a lot of the world decides to lower interest rates, revenues of all these companies could increase, and a lot of the United States stocks are heavily overvalued, so it may not look that attractive. I mean, like, even with Nvidia, right? Is it really, like, do you really think Nvidia is that attractive as a stock? If you were looking to invest, I mean, maybe if you were to invest in the company here, right? or even like in 2022 or 2023, it looks really attractive here. But when you look at Nvidia, for example, dude, does that really look that attractive? It looks pretty scary. Yeah. And when you look at the S&P 500 too, it's like that thing is being held up by a lot a lot of these speculative overgrowth companies. So yeah, it's kind of scary to actually invest in these kind of ETFs or indices, or a lot of these ETFs or things like that that are heavily dependent on the performance of these indices, because it seems very, well, frothy in my opinion. I guess is the nicest way to put it. But yeah, that's pretty scary. And a lot of these United States companies are currently like that. They're just really like bubble territory. They passed their COVID all-time highs, and oh, sorry, didn't mean to say that. They passed their all-time highs during the stuff, and now they're still going. And it's like a lot of these companies are super dependent on China for like everything. Like this might as well be a Chinese company at this point, right? But yeah, so it's pretty looks pretty risky, in a sense. I mean, if you buy down here, it's not, right? But if you buy on the top, a little bit speculative, right? So, I would personally, for me, at least I am personally looking at undervalued and underbeaten, right? So, beaten down. So even with like Meta, I bought Meta when it was near its when it was in its recent lows. I think I bought around here, right? And I bought around here because all the news was negative on Nvidia, but I was like, well, at this point it's pretty undervalued in my opinion. So I ended up buying some calls here, and I sold around here, which is, I think it was a little bit too early in my opinion now that I'm looking at things. But it's like generally when there's bad news but the underlying company is really good, then it's sort of, maybe to me it's like I'm looking for value, right? But yeah, it's getting pretty scary when you look at these things. And if you're, especially think about it, if you don't think it's scary, think about it like if you're an older person and you're looking to retire soon, do you really want to buy an indice or an ETF that's consistent of a lot of these companies being overvalued, in my opinion, with high PE ratios, with revenues that are heavily dependent on their countries, that you want to antagonize? Maybe not, right? So yeah, pretty scary. But then like when you look at Alibaba stock, did this company end up being worse? No, the revenues I believe have 10 times if not more. Yet look, it's trading near its all-time lows almost, if not. And same thing with NEO stock. I mean, this thing is selling over 500,000 vehicles. It has a battery swap, which could lead towards other electric vehicles becoming irrelevant without it, and trading at near all-time lows. Same thing with Tencent. This thing is trading pretty low relative to its all-time high. It didn't recover like all the other United States companies, and it's like, well, why, right? Does it make sense? Like from a logical point of view, does it make sense? To me, no, it does not. So this is the company that owns a lot of the stuff you see in the United States. Your Riot Games, League of Legends, I think Fortnite, I think a lot of other things too. You can look it up, but this thing pretty much, you see this, you interact with Tencent every day, and it's ridiculous. And again, like, this is pretty much a Chinese company, okay? Nvidia relies on a lot of China. I don't want to get too much into that though, but so I think personally, as investors look to take profit from overvalued United States stocks, especially with the macro shifts, the global macroeconomic financial shifts that are going on, they'll probably look into Chinese and some beaten down US stocks, but mainly Chinese, especially when you compare it to other markets that have been performing very, very well. And we will see a shift and maybe even some signs of capital flight from the United States into foreign and Chinese stocks as a hedge against real United States economic downturns that may not be so obvious when looking at the glossed over numbers of the United States economic data. So lower interest rates in the United States would promote capital outflows to see higher returns in China's undervalued markets. Other markets have performed very well, but China's stock market lags behind despite its importance. A few criticisms by bears would be like things such as demographics, but then like, okay, I do research on this part, and when you look at Japan's demographics, it's much worse. Korea's demographics, much worse. America's demographics, even worse. So well, this can be offset by immigration, but yeah, when you look at Japan and Korea's demographics, not doing too great at all. Yet their stock markets are doing very well. Um, Another criticism I see about China's economy is the housing market. Yet China's economy has popped in terms of their real estate, and it's deflated. So the housing in the United States is in an astronomical bubble that's unsustainable, especially with consideration to Maslow's hierarchy of needs. So, despite China deflating their bubble, which you need in order to promote urbanization, to promote more people from rural areas moving into the cities, the U.S. Speculators were hurt the most when it came to the pop of Evergrande, for example. But in my opinion, this is beneficial. And again, Xi Jinping did say that it was beneficial for the houses are for living in, not speculation. So, China owns the means of production and most of the supply chains, and most of the and most of the United States companies rely on China in order to be profitable. Again, like with Amazon, 60 or 70%, especially if they're logistics and retailers and things like that. It doesn't really make sense to me to be bearish on China, especially with everything I've just said and more. To me, it could be Western lies. Maybe the Western media is making things seem worse than what they're not, and they did this with, they pretty much try to make things seem better when it's not, and tell you to do things when it's wrong. So if they want you to sell, they'll make things seem really, really bad. If they want you to buy, they'll make things really, really good, right? So they'll tell you to buy Nvidia as it's reaching all-time highs, and they'll tell you to sell Nvidia when it's at its all-time lows. They'll tell you to sell Meta when it's at its all-time low, and they'll tell you to buy Meta when it's near its all-time highs. You see what I'm saying? They don't have your best interest in mind. But yeah, so high growth sectors would probably benefit the most, in my opinion, from the world shifting towards lower interest rates. Chinese tech exports would also become much more competitive due to a weaker dollar. So a weaker dollar could be due to the U.S. domestic monetary policies, a lot of the global shifts we're seeing away from the United States, and all the benefits that the United States had to make it a reserve status are going away. But when you look at just the market data available, let me see. We're going to look at different stock markets here, and we're going to compare how well they performed over time, especially with consideration to post 2019. So with post 2019, the FTSE is doing pretty well, actually. I believe that, it's past its all-time highs previously in 2018-ish. Let's see, the Japanese Nikkei. Japan has officially surpassed its all-time highs, I believe, in 1989. The Hang Seng, unfortunately, though, despite owning all the means of production, I mean, there's also the Shenzhen too, right? But I'm using this one because people are more familiar with this one. Despite being China, it's not doing too well. The Nasdaq, for example, too, has surpassed its previous all-time highs. The S&P 500 has also reached its previous all-time passes previous all-time highs. The German market has also surpassed its previous all-time highs. Oh, this is the FTSE again, the European market. I don't really know what the MIB is. This one's not doing too well, but relative to 2009, it's been on an upward trend. So I don't know what the MIB is. I'd have to look that up. Let me see. See what it comprises of. Oh, okay. Current Milano Italia Borsa. I think that's like a specific part of the FTSE, but oh, okay, constitutes. Let's see. I don't really know for sure what it constitutes. I'd have to do more research. It's probably certain parts of Europe. I don't know for sure. I'd have to check. But basically, every market, for the most part, has been performing very, very well, despite a lot of its financial, domestic, and economic problems, without future potential growth. Yet the Hang Seng has not done too well. I mean, maybe it's bottomed around here though, right? People have been speculating for the past year or so that the Hang Seng has bottomed, and that that there could be a potential for the plunge protection team every time to help the Hang Seng recover. But yeah, it's like, if this reflects the Chinese economy in some sense, which it doesn't necessarily, but if it did, it's like, can you really, does this really make sense, especially when other countries like Japan have the same issues in some senses? In my opinion, no. So, I would wonder if there's some value to be had here, in my humble opinion. So, yeah, these are some of the things I want to go over. I do think that when the Fed lowers interest rates, it could be beneficial to some people, depending on where you place your bets, right? But yeah, in my last video, I discussed more about the shifts and how the Chinese stocks could benefit from changes I could see occurring in the financial markets and the global economy. I do personally believe that China is in a position of strength, and I articulated a little bit more in that previous video. The best thing to do for me is to find opportunity and what is a good value to me, right? So this can change varying from person to person. But the U.S. economy is a debt-driven economy, but I think that's a little bit unsustainable, and we're starting to realize the cracks in that. And maybe investors, as we've seen, are starting to realize that, are diversifying away from the United States. But the United States has to keep pumping its debt-driven economy, so it's not looking too good, in my opinion. So in this video, I just gave some general, broad point of views on things. And I could have gone more into supply chains. I could have gone into more of the economic data. Like, for each of these different things I have here, like, there's so much more to talk about, but I didn't, right? Because then this video is going to last too long. So yeah, with that being said, none of this is financial advice. Please do your own research. This is just my humble opinion. It's a joke at best. So if you're here this long, I would, please, if you have any questions, feel free to ask. I will definitely try to answer them the best I can. If you share this video, it would really help me out, because I don't know, it motivates me more when I actually see people interested in it. And I feel like if more investors or more people start to consider these things, it could be good. But again, none of this is financial advice. Please do your own research. Everything I've ever said in these videos or on this YouTube channel, wrote, just my humble opinion. So sorry for this video being unstructured. It's just been a while. I just felt like the need to talk about these things, since I don't see anyone really talking about it too much. So, I could talk about the NEO videos. I could make NEO videos daily and talk about things about the company, but I don't feel like it would really be that useful, especially for me as someone who does keep up with the company nowadays. Again, I don't really feel like that's going to be too beneficial for me. I'd like to look at things maybe monthly or quarterly, depending on the need. And there's a lot of great websites that talk about the company, so I don't really feel like I need to, but yeah, I feel like people may need to consider these things just a little bit more. So everything is due to change. This is not financial advice. Please do your own research, and maybe I'll start going more in depth on things. I'm just trying to give some broad point of views on things. Okay, so with that being said, I hope you have a great day. Thank you.